Hey, welcome to the live stream. It is Thursday, May 8th, 2025, and we've had overall a good week. We've had a positive week if you count the really nice rally that we started yesterday and ended today. We went up about 2% on the NASDAQ if you look at one of the low points yesterday. So it's been a pretty good week if you consider it all. And the year itself, it could be a lot worse. We've picked ourselves up from the real bad lows we had in the beginning of April, and we're up 17% from that point because we had a market that was really selling off from February 19th until April 8th. Man, we went down close to 24% on the NASDAQ. Man, what a drop. So we'll see what happens. This is a long-term game. You got to just buy good companies for a long investor. Buy good companies, buy them at a good price, and then over the long term, make money, grow wealth, see an investment go up in value. And that's definitely what we got to do this year. It's been just a couple months of this volatility, and we've had some headlines that are moving the market, right? We've got, I think, a smaller tariff agreement between the UK and the US being settled. I think that was some positive news. Some earnings came in that were good, but we're to a point in earnings now where it's a lot of smaller companies. I mean, the largest of companies is maybe 100 billion, maybe 150 billion. We're done with those massive cap stocks that really move the market. So now we just have like literally 200 earnings were announced today. So they're just all over the place. So year to date, we'll see where we go from there. Looks like the S&P is doing a little better. It's down 3.7, where the NASDAQ was down far more. And the Dow is down 2.76. All right, looks good. Looks like Sergio is in attendance. How you doing, Sergio? Good to see you. Jay Zev, good to see you. And thanks for attending. Hopefully you guys are doing well. As we finish the first full week of May, we got one more trading day tomorrow. So if we look at a couple of stocks stood out for me. Google had a terrible day yesterday. It went down like 7.5% because there was a story, and I think a new war may be beginning between Google and their official name is Alphabet, between Alphabet and Apple, because an Apple executive fired a shot across the bow. They were stating that, hey, they saw search go down on the Safari browser, and that it really worries him and so forth, that AI is going to change everything. Well, it was really a bit of news that the investors that believe that AI is going to be a substantial market share player for search and advertising, they think, hey, that's going to be the end to Google's super profitable search advertising business. And Google stock went down 7.5%. But I bought Google shares yesterday. Today, Google went up close to 2%. But I think the battle is just beginning. I think these guys are going to go up against each other. Now, I've always thought that these really, the two that I think are really the big competitors in their spaces are Google and Microsoft, because you look at their businesses, they're very similar. They have a big public cloud business. They have an applications business, applications. Search is their, cash cow. Microsoft has like all the operating system cash cows, like their Windows operating system. Every PC made with Windows, you have to pay a licensing fee to Microsoft. All the people that used Word, Excel, PowerPoint, all the Office products and so forth. So these two companies are really strong. And I think Apple is kind of a one-trick pony. They have the iPhone, and that's about it. And everything having to do with the iPhone. You take away that iPhone, these guys are not close to the value. Their business is not worth $3 trillion. It's worth 500 billion, excuse me. So we'll see how these things play out, but we may have just witnessed the very first battle or fire shot, and this has become a war between Alphabet and Apple. That may be the case because it really was interesting. I went ahead and kind of fact checked that statement. The number of searches made in 2025 went up. The amount of money Google made, as announced on their first quarter earnings, went up 10%. So the facts are, okay, the Google search business is growing. So what Apple was talking about, maybe very specific to the Safari browser, very specific to Apple. Who knows? I think Apple's going to have to search for their strategy because they don't really have a good one right now. Looks like Herdo's in. Good to see you. Thanks for joining. Hope you're doing well. Jay Zev, you picked up some Google as well. Not a bad move. And then Alias Zero. Google is not a leader. Keep this in mind. Well, I'd like to challenge that, or challenge is the wrong word. I would like to give you my perspective on that. Google is the leader for search. I don't think they're dominant leader in search. When we look at YouTube, that's the leader in streaming. More people stream on YouTube than on Netflix or any other platform. And YouTube is growing faster than Netflix or any other platform. So they're the leader in streaming. They're the leader in robotaxi. They're the only one that is providing a proven robotaxi service that is driving people around, doing like 250,000 rides. Is it a month or just a big number? And so that's leadership. And the AI, space, at this point, there's at least 10 very big companies that are trying to get a position in the AI business. So we'll see. Hopefully, the AI business becomes something that's profitable. Wouldn't it be funny if it was all just a big cloud of attention that never came with any profits? We've had those before, by the way. Herdo, thank you so much for the super chat. You're awesome, man. Thank you so much for your support. I really appreciate it, for you being a member and for giving me a super chat. I really appreciate it. Let me know if there's a stock or any topic you want me to take on. I would be happy to do so. So, Alias Zero, love that you came with a point of view. Please keep coming back and let's discuss it. Okay, so Nichix, good to see you, man. It's been a little while. Mercado Libre is on fire. Nice. It is. And that's just a solid business. And I did a video today on it. And what I think Mercado Libre is quietly, letting the whole tension around tariffs kind of happen. And they're kind of avoiding it all, because if you import from Asia into South America or Mexico, I don't think there's any conflict there. Like, there's no tariffs being charged. So like, all right, hey, you guys up there in the US, between US and, China, US, and a lot of countries, you guys knock yourselves out. Mercado Libre, we're just going to stay away from all that, all the hostilities, all the noise, and just keep growing our business. I also like that they're diversified across different businesses. It's not just e-commerce. They do e-commerce, but they do financial services. They do a variety of things. So really nice business, and grew 37% top line. That's beautiful. They're profitable, good free cash flow. So I've been buying them kind of strategically. When you look at the stock, you know, volatility, in my opinion, is our friend, because when we look at volatility and you look at a Mercado Libre, it's doing really well over the 1 year, right? Up 40%. That's great. But it gives us these moments where you're like, you're going to discount Mercado Libre that much? Thank you. Buy it up. You're going to discount it this much? Thank you very much. I don't know what I did to deserve all this, like all these awesome discounts. But all kidding aside, this volatility is where we make money. You know, doing one's homework, getting an intrinsic value on a stock, knowing what it's worth, and then buying it at the right time. Money making operation right there. And Mercado Libre has given us those chances to buy into the stock. I would say the stock is still at a discount, but if you look at my video, you know, not a big discount, just a discount, which is not super compelling. All right, Herdo, you want to look at PayPal? Let's take a look at PayPal. So PayPal Holdings, I am a stock investor in PayPal. And it was doing quite well in 2024. It really got up to a nice price. And you see this rise, went up 60, close to 60%, but it's really come down and sold off 34, 35%. It started a nice little jump. I have noticed that over a month's time, up 22%. And let me see, let me bring up some more details on this. We'll do a full review of PayPal. So they announced on April 29th. So they won't be announcing anytime soon. They announced, and then the stock started to rise. Now, what's interesting about PayPal is kind of like, it's kind of like the stock that's getting bullied at school. You know, nice kid, does his homework, gets good grades, doesn't bother anybody. And for some reason, the kid keeps getting bullied. So PayPal, and when I say gets good grades, well, let me see your report card, PayPal. You've been growing your top line revenue. Okay, good job. You've been doing your homework, taking care of that top line growth. Good job. And then when we look at profitability, have you been making money for your investors? Sure have. Earnings per share is there. Growth in earnings per share. And have you been generating cash flow? Absolutely. And that's the most important grade. That's like math for me. Like, you got to pass your math. And they've been hammering the free cash flow. So PayPal is doing really well. They're generating free cash flow. They're growing their free cash flow. They're profitable. They're in a lot of different use cases for their payment system. But the market just doesn't have a ton of love for them. I mean, if they changed their name to like Palantir or AppLovin, it'd be like, oh man, this thing's going to go up 10,000%. But all kidding aside, let's look at the valuation of PayPal. So the top line growth is good. And the reason I don't have to work on the valuation is it's already done. And I'm going to show it to you in a bit. So top line growth, green flag. Profitability, green flag. Lots of free cash flow and it's growing, green flag. Let's take a look at the balance sheet. Balance sheet. $11.21 billion of cash, $13.38 billion of debt. So net debt of $2 billion. No problem. That means that their debt to EBITDA is 2.05. So less than 3 years. So the balance sheet is fine. The forecast, 30 analysts cover the stock, and they think it's close to 19% discounted. The most optimistic analyst thinks it's $125 stock. The biggest bear is this is a $49 stock. This section here of stock analysis, one of my favorite sections, because here 47 analysts, this is a lot of data, right? We're taking the average as all these analysts put their projections on a company. We're seeing that up here. So we're seeing growth. Now it isn't like record breaking growth, but Apple's not growing. You have a pretty big business that's growing 5.5% this year, 6.27 next year, 6.41 the year after. So they just keep growing, and they're expanding their earnings per share much faster, 28%, 11%, 13%. So the profits are expanding faster than top line. So the top line shows some steady growth. The earnings per share growth show very good growth. So with that in mind, I just find it interesting that this is a stock that is just worth more money than its current stock price, because the fundamentals are just really good on PayPal. PayPal 4 years ago was flying high, and I'll show that in a bit. So when I look at the free cash flows the company produces, I mean, it just produces really good cash. It produces high cash. I'm growing them just at the rate of revenue growth, even though their profits are expanding much faster. So this is kind of a conservative growth rate. And then long-term growth, growing it at 4%. And I get to a present value of all those cash flows of $167 billion when I use an 8% discount rate. And I add cash, take away debt, and I get to an equity value of 171 billion. So net, when you look at the value per share, each share is really based on the cash flows worth $171 per share. And the stock price is trading at $70.47 a share. So big discount, big compelling discount, 59%. I own a lot of PayPal stock, and I'm happy to own it. I'll just keep it. I'll keep it in my portfolio. If they keep putting up numbers like they're putting up, I'm not going to buddy up with PayPal here, even though they're getting bullied by the market. Looking at earnings per share, it's 27% discount. I kind of agree with the analyst on earnings per share. I blend the two valuations, taking more weight in free cash flow. This is a compelling discount for a really well-known company. And, not too long ago, this stock was trading at $300 a share. The market was really, really excited about PayPal. It really sold it off, but so did it sell off. It sold off all the greats: Meta, Google, Microsoft, Apple, Nvidia. Everything was being sold off during the 2022 year. This one just didn't come back. But that's an opportunity. This company, I'm going to steal a line from Jeff Bezos, the founder of Amazon. And in the depths of the dot-com bubble, the stock price was really low for Amazon. And he wrote a letter to his employees, and he used the phrase, "The company is not the stock price, and the stock price is not the company." And what he explained to his employees was, we're on the right path. We keep growing our top line. We keep obsessing on the customer. We keep making our business bigger. They keep coming back. And all those things matter. That's what matters. And over the long haul, obviously, Amazon proved to be on a path to create tremendous value for everybody, including their customers. PayPal isn't like Amazon in every way, but I would say that the PayPal stock is highly discounted. And I think the PayPal business is really attractive because PayPal has integrated itself on a lot of websites, a lot of business applications. It does business around the world. Venmo is the best you know, peer-to-peer money transfer app that people use in the United States. I don't know what it is internationally, but here in the United States, I've been using Venmo for a long time. Everybody I know uses Venmo, and the banks are so insecure with PayPal having that kind of power over that many consumers that they tried to come out with Zelle, and then Zelle forgot what happened with Zelle. There was some big controversy because hackers or scammers were getting to people and getting them to send money on Zelle, and then they couldn't recover the funds. So Zelle hasn't been a very successful, application, but that was a direct competition with Venmo. So there's just a lot to like with PayPal. And I put the company, it's a desirable company. It's a desirable company with a solid discount. I would bet that at some point the value is going to, over the long haul, like Warren Buffett, or I don't know that Warren Buffett said it. I think it was Benjamin Graham, who was Warren Buffett's kind of idol. He said that in the short term, the stock market is a voting machine. It's a popularity contest. Hey, which stock is super cool? As Warren Buffett would say, those are casino stocks. Those are stocks that people want to see right up, oh man, that stock's really, really going up. But over the long term, the stock market is a weighing machine. It'll weigh those cash flows. It'll weigh how much cash you're putting on that balance sheet. It'll weigh, are you making your business bigger, more powerful, bigger moats, stronger moats? You're so good that the government starts treating you like a monopoly because you're so strong and powerful. That's the weight of the value of your company. And when that happens, your stock price is going to go up. And I'm in it to grow my wealth long term. And once you get your portfolio and your assets being stocks, bonds, real estate, crypto, but once you get it going, compounding, it's a beautiful thing. Your money, your wealth works 24 hours a day, 365 days out of the year. When you're sleeping at night, nice and warm in your bed, nice, comfortable, warm blanket, your money's working. On weekends, when you're enjoying your weekends, your money's working. It doesn't always work like smoothly, right? Like, oh, every day's a net gain. But over the long haul, your money is working 24/7. Every day shows up to work. And as Warren Buffett also said, if you don't find a way to make money while you sleep, you'll be working for the rest of your life. And he's right about that. So it's great that you're on this live stream. It's great that you're investing and learning how to invest in stocks so you can find the stocks, the bonds, the real estate that's going to work 24/7 to build your wealth. And then you can retire early. You can have stuff if you like stuff, and you can buy nice stuff. You can buy nice houses, that kind of thing. So PayPal, I like PayPal. It's my kind of stock. Now, if the stock could go up like I want it to, that'd be great. Now, diversification. If you own 10 stocks that look like PayPal, it's going to work. If you find fundamentals like this across PayPal, Robinhood, and a couple of others, it's going to work. Meta looked like the bad part of PayPal for a while. So did Netflix. I'll show Meta. So for a while, Meta was like, oh my God, this one needs a makeover, right? It's down 76%. Oh boy. But the market was just saying, hey, study the cash flow, study that profit, study the growth. Because over the long haul, the market's going to weigh those profits and it's going to say this company's worth a lot more. I'm waiting for this to happen with PayPal. But again, diversification's our friend. When you diversify across different stocks, we don't need that one stock to make it all happen, right? All these stocks are working 24/7 for us. but some are just going to gain value much faster. Meta being my top dollar producer for the last couple of years. And then some that are riskier, like Robinhood. And this one was risky, but I believed in them. I was like, they're dominating the new investor market. They do things different. They don't follow the rules. They purposely do not focus on the rules of how to run a brokerage. They focus on what their customer, which frankly, their customer didn't trade 10 years ago. They didn't invest 10 years ago. And their customer grew up with video games and fully digital world. And they're crushing the market, 202%. Got a couple of these in my portfolio. And so the ones that work are just driving great gains. The ones that don't work that are still really valuable, I keep them in my portfolio because they're going to work at some point. So I'm glad you asked about PayPal. Herdo, thanks again for your support. It means a lot, dude. Thank you. All right. Elon Rosenstein. I got 20K in Google at $155 a share. Well, I think Google is a great business. Everything I said about PayPal, transferable to Alphabet. One of those most powerful businesses on earth. And they're doing a lot of things right. The market is hung up on some stories that is, I don't believe the stories. I don't believe the theories. I actually believe that these guys are just going to keep getting bigger and bigger and bigger and more valuable, more valuable, more valuable. So you're at 155. So I guess you're even right now. If you would have asked me, like, coming out of 2022, right? These guys did sell off in 2022. Everything sold off in 2022. It did do well coming out of it, 74%, but it didn't do what Meta did, right? And if you would have, if I would have been asked, well, which stock's going to do better coming out of 2022, Meta or Google Alphabet? Google Alphabet. I would have been like, I don't need to think about that. These guys are like really good. And I've been surprised that the stock hasn't done better. I think Google doesn't, it's a little bit of like the Amazon story I talked about, that Jeff Bezos did not focus on the stock market. He focused on the business, and he made Amazon better and stronger, and he focused on the customer. And when the customer needed web services, he created Amazon Web Services. Now that is the biggest, most valuable part of Amazon. Alphabet's like that. They started with search, dominated it. Nobody wanted to do search. They weren't the first ones to do search. Okay. There's like 20 companies that were doing search, but nobody did it as well as they did. First, they dominated, and then they monetized, and now they make a ton of money. They saw that the YouTube business was really desirable. They acquired the company. Great acquisition. Now they started the cloud business. That's going really well, growing really well, good profits. The robo-taxi business, Waymo, it's a platform business. Wonder what they're going to do with that. Well, that's really not priced in the stock. We're getting that business for free. And that's a real AI business. It's taken them more than 15 years to get to where they're at. But it's the real deal. You can go to San Francisco, Los Angeles, Austin, Atlanta, Phoenix, and you can have a machine, a car without a driver, pick you up, take you from point A to point B. It's pretty damn amazing. And that's Google Alphabet. So I did a post today because I did research. The story was, well, the Apple executives said that their search in Safari, which is the browser that runs on iOS, saw search go down. And maybe that was the case. But overall, search is up. Searches are up for Google. And second, Google's making more money out of search in 2025. And I bought more shares of Google yesterday when it sold off at 7.5%. I took that discount and gladly bought more shares. All right. So Zim, you're asking about Zim. Zim is risky, really risky. I mean, tariffs are going to reduce the amount of shipping. You reduce shipping volumes, rates go down. Then life does not look pretty for Zim or other shipping companies. If you have lower shipping rates and lower volumes, that means way lower revenues, and your costs stay kind of like the same, right? You got to run your ships. You got to have your people on the ships. Good news is oil is down, which is an input cost to their business, right? The oil they have to burn to operate the ships. So I'm staying out of Zim. I'm not in Zim. I'm not getting into Zim. Can it get back to 25? I don't see that for the next year. And I'm just looking at the macro, like what does the next year look for shipping? It doesn't look good. Alias Zero. Block is an interesting spot. You know, Block for probably about 4 or 5 years ago, I think their CEO is interesting and he's brilliant, right? I think he was either the founder or co-founder of what was Twitter and now is X. Then he decided to move over to Block. And so he's a brilliant guy, Jack Dorsey. And he's a freaking brilliant guy. But they just haven't been able to produce the fundamentals that make this company valuable. Cash flows, they don't exist. The revenue growth has been inconsistent. So when you compare them to PayPal, PayPal is an A student and Block is like one quarter they're a B student, the next quarter they're a D student, the next quarter they're an F student. It's like, man, what are we going to get? And you see their stock price has just been all over the place. And they and PayPal were dominating coming out of the pandemic. People were spending their stimulus money like they didn't earn it, which was a fact, and they were spending it on sites that use block payment systems or PayPal, and they've had a hard time just getting anything going. So I'm a bigger fan of PayPal. The fundamentals behind PayPal are so much better. So, but do your own homework and have your own point of view. Like I respect the person who had their point of view on, I already forgot the stock, but please bring your point of view to live streams, calls. Let's talk about it. 'Cause sometimes I've made money on stocks that have come out of this live stream. Let me show you one of them. So this stock had a nice week. It had a really nice week. It's up 30%, 30.56% in 2 days. And this came out of live stream. And I'm like, who the heck is Oscar Health? And then I did some homework and I'm like, whoa, these guys are growing really well, profitable, cash flow. A couple super investors, including Michael Burry, own them. So come to live streams with your point of view. And I can probably rattle off 10 stocks that I thought were really interesting that came out of the live stream. And I became an investor and I made money. But here's the example of the week. And I don't know who brought it up, but whoever did, I think I'm gonna take my wife out to dinner tonight. I'm gonna say an attendee of the live stream. We got that person to thank, sweetheart. Order whatever you want. Mother's Day is around the corner. I'm gonna treat you tonight. So keep your point of view coming to these live streams, please. Okay, so Michael Anthony, the bass player for Van Halen and an incredible investor. What is wrong with Pfizer? Dude, I've been asking myself the same question. Now, I would say that Pfizer, the last quarter, was not a good quarter. They did not grow. Disappointing. I'm thinking of switching from Pfizer to Novo Nordisk. Novo Nordisk looks pretty darn good, more consistent. I'm not looking for Pfizer to, be the next Meta or the next Oscar Health. I have Oscar Health and a couple of others that are just killing it, like Catalyst Pharma. Man, I love Catalyst Pharma. This one's just crushing it. I got these in healthcare. Pfizer, I just need you to be kind of like a consistent player, and they've been inconsistent. I'm like, well, not doing the job in the portfolio, man. Might have to get rid of them and switch over to Novo Nordisk because they got some high flying healthcare stocks, but these are riskier. They're smaller caps. They can go up and down. This is less than 3 billion in market cap. I love this company, doing really well, but I like having some bigger caps too that give me some stability. So I just don't know what's going on with Pfizer, man. They've been inconsistent. David Knight. A lot of people love SoFi, but are missing a very better business in South America. New Holdings. Yeah, I'm an investor in New Holdings. I fully agree with you. I think when you look at the fundamentals behind New Holdings and look at this volatility, isn't that a beautiful thing? Some people look at this and go, oh my God, this is ugly. I'm like, no, this is beautiful. I can get New Holdings stock at $9.60 a share. And I can get it at $10 a share. And I can get it at $10 a share and $10 a share. Isn't that beautiful? It's like, you go to the restaurant, they give you a $50 steak for $10. Thank you. It's great. So I've made money on New. I really like their business. I think they're terrific. And I also like the diversification into Latin America. Most of my stocks are US based, which is fine. But now I think US stocks are expensive. I'm not breaking any news. And New Holdings, I hold way above SoFi. I've done videos on SoFi. I always fall short on valuation. They're doing something that is working for the top line, but it's a business that's not very desirable. The difference between, and really the one that I hold above SoFi is Robinhood. The reason I bought Robinhood is they're not going to do brokerage services like the old brokers did, just doing it better. No, they're like, no, we're not even going to use any of the stuff that you do. We're going to do it our way. Zero cost trades, gamify the experience. They just think very innovatively. They disrupt things. I don't think by purpose, just by obsessing on their customer. So I love that about them. And in financials, if you're going to think about SoFi, I think there's other companies that have a much better idea and are doing far better, and they have more profit. Look at the profit for Robinhood and the cash flow for Robinhood. It's awesome. So that's why I went with Robinhood. Robinhood's probably the best winner in the space. New Holdings has been good, but I have 8 times more money in Robinhood than I do in New Holdings. What's up with Merck, dude? Merck is not doing anything. Merck's been around forever, but their stock is just kind of, it's not growing. It's not doing anything. I don't know what's going to happen to that stock. They need something exciting, and they don't have anything right now. All right, so, and then the buy now pay later space, it had a couple of like good weeks or months, and it's kind of gone a little bit quiet. I think because the concern around recession, if you get into recession, those buy now pay later companies, if they start getting really big losses, boy, those businesses are going to suffer fast. So I think the buy now pay later businesses were kind of cool, kind of eye catching, but just be aware if they have a lot of people default, they're not going to get their money back, and they're going to be having to take a lot of losses. So we'll see what happens there. So here's David Knight. My main concern and the reason I sold my PayPal shares is that they stopped growing their user base. That's a very good point. Carlos, good to see you. So why did XYZ make a profit and why the big drop in earnings? I don't know. I haven't looked at Block. It's not a stock that I really cover. I cover like, geez, 50, 100 stocks, but that's not one of them. I just have analyzed it in the past, and I could tell you that I moved off a Block and I went into PayPal, Robinhood, Coinbase, and I'm glad I did that. Eric Johnson tuning in on X. What other qualitative variables do you consider when looking at a stock? Are there highly discounted stocks you wouldn't buy? Okay. Okay, so it's a very good question. I'm going to show this graph here. Okay. I created this because not all businesses are of the same desirability. Okay. You have, let me think of a business I just wouldn't want to have. Restaurants. I don't like restaurants, and I'm sorry if you like restaurants, but I'm going to go with Jack in the Box. I believe, I don't know what their symbol is. So Jack in the Box, obviously they have food. They're headquartered in San Diego, California, and they have really good commercials, in my opinion. But I'm not here to talk about commercials. I'm here to talk about investments. See how we can make a bunch of money. And they don't really grow. They don't have a lot of profit. They have to hire a lot of employees. They have to buy or lease real estate that's really expensive. You have to deploy a lot of capital to make very little money. And if you ask me, how desirable is Jack in the Box? I'm like, not very desirable. They're right here. Do they have a competitive advantage that keeps people from eating elsewhere? No. They make hamburgers and tacos. There's 100 businesses in every town that they operate in that's going to compete against that. Well, do they have like their nutrition level so high that people are just they cannot substitute eating elsewhere because Jack in the Box just delivers? No. It's not like a pharmaceutical where you have a disease, you have to take that pharmaceutical. No. Okay. So they don't score very high on the vertical. Now, are they growing their business? Are they profitable? Do they generate free cash flow? No. They're not growing. Very low profit, very low cash. And they have to deploy a lot of capital. Every time they open a new restaurant, man, intense cost. Now, Mercado Libre, they're running an e-commerce site. They're growing 37%. They're profitable, cash flow. They didn't exist 10, 15 years ago. Now they're gigantic, way bigger than Jack in the Box. So do they have a competitive advantage? Yes. They have expertise in Latin America where they really tailor to what people want in Mexico, Brazil, Argentina, Colombia, these places where they're like, hey, we want a certain catalog of products. So they have a competitive advantage against Amazon and Alibaba and against retailers in those countries that they get to do things on e-commerce. So they have that competitive advantage. Are they growing? Are they profitable? Are they creating free cash flow? Yes. So Mercado Libre is up here. So now, getting to your question, what other qualitative measures do I have? So this is one important distinction. If would I buy something in the red? I mean, very rarely. If it's like a super duper opportunity, like, hey, Jack in the Box, you're going to get shares at 50 cents a share or something ridiculous, maybe. Would I invest in the gray, which is companies that have a strong competitive advantage, but they don't grow very much, and they're not they're not very profitable and not a lot of cash flow? Yes, I would, with a compelling discount. And then like PayPal, I'd probably put like here, where they don't have a big moat because PayPal is payment systems. They do have a moat. name recognition. They're not growing incredibly fast, but they are very profitable, expanding their profits faster, and they're expanding their cash flow really fast. They're not expanding their user base. Somebody brought that up. So they'd be down here. So I want a compelling discount on PayPal, and I get it, right? So I look at that, and that's kind of putting me in the right lane. Like, hey, am I dealing with a business where it's super desirable? And if I were to get fair price and I really want to be in that industry, I'll buy. Fair price being intrinsic value equals the price of the stock. If it's in the gray, compelling discount. Stay out of the red. It's distracting. It's like, bottom feeding is just not what I want to do. I want to buy Mercado Libre, buy it at a good price, own it for a long time, make lots of money. That's what I want to do. Then once we get into that stream of thought, you want to look at top line growth, super important. Let me try to hit a stock that I know is going to have good top line growth. We're going to go with Shopify because it's been a good growth story. Okay. Really good growth. Now, Shopify, historically, when I look at it, it's overpriced, but very good growth. And growth in free cash flow, and nice consistent growth in cash flow. And this is where this one may not have an A grade because it's pretty good. Pretty good. But I really like smooth data. And this one's okay. So I look at top line revenue, free cash flow, want to see it grow. I want to see profit spill down here. Nice profit, nice consistent profit. And I want to see it grow, the percentage. Balance sheet, super important. You don't want to buy stocks that have problems because even you might have a really good business idea. And if you have too much debt and you have to keep paying debt payments, servicing the debt, as they would say in finance, you don't have money to grow the business. So your great idea is going to be copied by your competitors who maybe have the capital to grow faster than you do. Debt could be so limiting and it could drive you into bankruptcy. So you want to look at and make sure that a company has less than 3 times EBITDA. Okay. If they have more than 3 times EBITDA, that's almost untouchable unless you have a clear line of sight of, well, that's temporary and they're going to get back to under 3. And this is how they're going to do it. And you're getting a great discount. I'm getting an 80% discount. This company's coming back. Dow Chemical, I've invested in it recently. It's really working. That's kind of like the situation I invested in. Balance sheet, super important. Warren Buffett spends a lot of time in the balance sheet. He does not want to buy companies that are going to crash and burn. So this one looks good. $5 billion of cash, $1 billion of debt. They got $4 billion to do whatever they want with. Grow the business, buy back shares, pay dividend, all kinds of stuff. So strong balance sheet. Balance sheet's super important. Okay. So I'm looking at what's the business worth that's driven by cash and profit. Is it a sound business? Is it a good sound business? Balance sheet, and think of balance sheet as, we all, have our credit scores, right? Like when you go up, I'm going to buy a house, and they look at your credit score and they look at your ability to pay. They look at how much debt you have and you're earning, right? And how much you're going to pay for a house. If you have a lot of debt, they're like, sorry, man, we're going to lend you money because you're higher risk. Same thing with stocks. If a company has a lot of debt, the opportunities are limited, just like you as an individual. If you don't make a tremendous amount of money, you just make average money, and you're like, well, I want to drive a Ferrari. And you spend all your money on a Ferrari. You spend 200 grand, 300. I don't know what Ferraris are cost because I don't own a Ferrari. And then you pay, I don't know, $30,000 for insurance per year, maybe $40,000. Next thing you're spending 60% of your disposable income on that Ferrari. And then you go apply to buy a house. It ain't going to happen. They're going to be like, no, get rid of the Ferrari and pay off all your debt and then come back and we'll give you a loan. Businesses are a lot like that. If they have a lot of debt, their ability to grow is limited. I don't want businesses like that. I want a business that has great opportunity to grow. I want them to be, and I'm going to try to show a big business and then a small business. So Meta, let's take a look at their balance sheet. They got $70 billion of cash, $49 billion of debt. So they have net $20 billion of cash. So they want to go chase down AI, go for it. You got the cash. So they're chasing down AI. They want to create this AI business. Let's look at a small business. I'm spitballing here, so hopefully I pick a good one. So here's Catalyst Pharma, less than $3 billion in market cap. They have $580 million of cash, less than $3 million of debt. This is a small business. Not small, but you get it. Compared to Meta, they're tiny. They have $578 million of cash right there. They're a $3 billion, less than $3 billion market cap company. This cash represents that you're not paying. When you look at this market cap, it's not really a $2.78 billion market cap. It's 2.78 minus that 500 billion. It's really a $2.28 billion market cap because you have so much cash on that balance sheet. This is a really strong business. They've acquired smaller companies. They've made themselves bigger. They've invested in science to create the next pharmaceutical they want. They have the ability to grow because of that cash. So focus on that balance sheet. I don't think we focus enough on the balance sheet. And then earnings per share. Earnings per share. Now, not everybody on this channel is an accounting professional. I graduated in accounting. I have an MBA. I know financials quite well. I was a controller with big publicly traded companies, so I had to produce these things and got to know them well. You can really play around with the numbers to make earnings per share look the way you want it. And Charlie Munger hated that. And there's a lot of truth to that. But in a general sense, they are a good measure of a company's performance. It measures profitability. And we use accrual accounting, which means that you can take an expense in a period, maybe not take the expense in a period. And that's how corporations legally massage this earnings per share number. So Charlie Munger hated it. He didn't look at it. I like to look at it because it does measure. See this earnings per share, it's kind of gone up over time. That's a good measure. And it's going to pop up to $4. I want to look at it because I'm like, hey, this is what the street's going to look at and obsess on. I want to know, is the street going to be super excited in a couple of years if they hit $4 of earnings per share? They're going to freak out and buy this stock big time. My money's going to double. So I kind of answered your question. Hopefully that helped on what are the quantifiable measures I'm looking at. And then I created this model, and it basically puts those numbers into this model. Become a member. You can come on member calls. You'll get access to this model. That's what this model encapsulates. It's that whole train of thought. And investing, and I don't know what ages there are out there, but I'm going to guess that there's somebody on the stream that's 18 to 22, and then there's somebody on the stream that's 65 to 75. We're all over the ages, right? Which is great. Investing, the more you put your energy into understanding every number and the calculations, like you got to know net present value. What does it mean? Why do we use net present value in finance? Why do all these investments use net present value? You need to answer that question. And with, you know, AI nowadays, you know, and in YouTube, you'll learn how to do that. But you need to learn every number. So when you look at a company like PayPal and you go, these are the cash flows, and I'm looking at net present value. What does that mean? It means that if you look at, and you'll need to be able to explain that to yourself and explain it to somebody else. Okay. So I have a model here. I share it with members, and it's an example because I would want every member to, you can use this model, no problem. But I just want you to understand every number, because if you understand every number, you're going to make way better investments. You're going to look at a company and say, this is why I like the company. Understand what your, Warren Buffett talks about his sphere of knowledge, his sphere of and I forgot the term he used, but basically the things that he doesn't invest in companies he doesn't understand. So when he looks at a particular business in an industry that he really understands, he understands that, hey, that business has a particular desirability. And then he fits the numbers into his valuation model that he really understands. That's where I would encourage you to get to a point where you can look at a company and say, hey, that's a really good idea, but let me look at the numbers, and then we'll see if it's a really good business. I'm going to give you an example of a business that I think is terrific. Rocket Labs. Man, if I was in New Zealand and they're like, hey, Rocket Labs has a tour at their facility, but you're going to have to drive 4 hours to get there. It's going to be a 2-hour tour. You're going to have to drive 4 hours back. Sign me up. I'd love to do that because I think the company's so neat and the founder's so neat. But then we look at the fundamentals and I'm like, I'm never going to invest in this company. Revenue growth. Awesome. All right. You sold a bunch of revenue. Great. What are your profits? Terrible. Okay. Well, kind of an expression I have is I could sell $100 bills really easy if I sell them for $50. Man, I'll have a line of people around the block, a mile long, that will say, yeah, hey, I'd like to buy $100 bill from you. Here's my $50. And I'd give them $100 bill, and then they'd walk away happy. This is a company selling $100 bills for $50. It's amazing that they get rockets into space. That's what I'm a fan about. But the business is terrible, in my opinion. Now, some people might say, wow, but you don't get it. Someday they're going to be gigantic. They're going to be like 100 billion. Okay, so they're going to be like Google? Yeah. Or Microsoft? Yeah. Or, well, I'll just go buy Google, Microsoft, or I'll go try to find the next software company, which is what Microsoft is, or Google, which is a communications company. But I've yet to see an aerospace company achieve high value. It just doesn't happen because look at these numbers. Gross margins, 26%. Microsoft's at 80. Pharmaceutical companies are 85 gross margins. So keep that in mind that sometimes you look at companies and go, hey, that's a great idea. Then you study the fundamentals and you're like, wow, man, they don't make any money. And I don't understand how they're going to ever make a lot of money. And these businesses will, unfortunately, if you study this particular industry, a lot of businesses go bankrupt. I'm not breaking any news there. And their valuation's 10 billion. Again, I'm a super fan of these guys. I think it's amazing. I'm also, so there's other businesses that came and went that I was like, wow, that was pretty neat what they were doing. All right. And SpaceX is going to come out, and then they are going to be a big price stock, but they're probably going to resemble what I just showed you on fundamentals. I'm probably not going to invest. I've been aware of this business. In my professional life, I've had aerospace clients. It's a tough business, man. People don't realize that You can have one failure and it really just crushes your company. I had a client that they launched satellites into space, and they were doing great. Um, they were growing their top line, and then their next big growth was they're going to launch these satellites, and the satellites were actually going to provide broadband Wi-Fi, especially to remote areas. And we're talking like 10 years ago, okay, ahead of SpaceX. They launched the satellites, and the satellites were defective. They wouldn't start. And once you launch into space, you can't call AAA. Hey, can you go change a tire? No, it's in space. You got to either go catch that darn satellite. If it's that valuable, you go catch it. But if it's not, you're not going to spend the additional dollars to try to go fix it. So it was like a complete bust. It was like $600 million down the drain. It really crushed them. That's what you're dealing with when you're dealing with space. So just be aware. Be aware. I invest. I have fun, but the principal rule is I want to make money. I want to grow my wealth. And these are cool businesses. I love Star Wars. I love gaming companies, but gaming companies are all not that great of an investment, right? Um, I raced bicycles for a long time. Bicycle companies, terrible business. So the things I like may not be the best investments. Everybody loves cars, right? Well, the car business is a really tough business. All right. I'm going to try to answer your questions a little quicker. All right. So I've looked at PAGs in the past, and that's Pag Seguro. And there was a couple of red flags that kept me from going all the way, and I just didn't invest. I think Pag Seguro is a followed stock on the reference sheet that I publish out to members. Sebastian Pacheco, it's been a little while, man. Good to see you. So, how much money did you have? So so I'm 56. I started investing really when I was 25. Yeah, and I remember I started with like $2,000. I didn't know what I was doing. I just wanted to do it, and I started to, dig in, and I started putting money away. Like, I was working professionally at that time. I just kept putting money in and started buying what we had mutual funds then. ETFs were not a thing back then. Now I buy ETFs, to for some investments. Like when I invest in Germany, I have an ETF. I just kept putting money into my brokerage accounts and so forth. And I bought real estate. Real estate was a really good investment. And like at $2,000 at 25, and I think getting to 100 grand took a while. Like, I don't know, 10 years. And then getting from 100 to a million took like maybe another 10 years. But then doubling that million took like 4 years. So it just really starts scaling up and compounding. So it starts small, and then it just keeps getting bigger and bigger and bigger. And I got wiser and smarter, and I realized, what was my recipe for success? This is my recipe for success. And this is my recipe for success, right? I'm not out selling a kind of, hey, if you do it this way, you're going to be successful. I never recommend you buy, hold, or sell a stock. It's always just, I want to have a community of people that are passionate about investing, want to grow wealth. And I'm showing you my example that I hope you find interesting, you learn something from, but then I want you to create yours. I want you to become a super investor. So that's an answer to your question. That is a good question. And I know, like, when I was young, I was like, I'm putting money away that I'm probably not going to touch for like, I don't know, 30, 40 years. And that's investing for you. But I'll tell you, I don't know if there's probably a couple parents out there. There's probably some parents out there that have already raised kids, and you're gonna totally know what I'm talking about. And then you have some people on the stream that are like, yeah, I've got a 2-year old, or I got a 10-year old, or I got a whatever year old. So my boys, I have 2 sons, and I paid my own way through college. And so when they got to college age, like, you can go wherever you want. You can go to the most expensive college in the United States. You can go to the least expensive college. It's your decision. I got the money, and we got it all saved up for you. That was a very, for me, it was very rewarding to be able to give, my sons that I care about so much, like, you can go to college wherever you want. And the older son went to a nice private school, had a really good career. Now he's at another school working on a PhD. The younger guy, he's almost done with his schooling, his college. He'll be done after the winter semester. That's money that I put away like 20 years prior, and then it comes back, and you're like, sweet, it's pretty cool. Bought my wife a nice car, $100,000 car cash, November, and that felt good. My wife had a car that was 12 years old, and so I know investing, like, it's not like, hey, the gratification of doing something, it's not immediate. It's like long term. But that is what I do. And if you're interested in long term wealth creation, I think that's how it's done. All right. So Michael Anthony, Eric Johnson. All right, cool. So Lyft, you guys are talking about Lyft there. Okay, we've been on for about an hour. So let's look at some stocks that I did want to look at. And one of them is United Healthcare. So do I have United Healthcare up here? I don't think I do. So, all right. So United Healthcare, this stock, I owned it for a long time. It was a really good winner. And this doesn't show it that well. Maybe it does. See how it's just been a really good winner over the long haul. And I decided to sell it, I think around here. Mission accomplished, did really well with it. And that was that. Over the past year, these guys just been, it was brutal. Their CEO got assassinated, a lot of bad stuff. And their stock's really beaten up. Now, these guys are in a business that they continue to grow. Top line growth looks great. Okay. And they continue to be a cash generating machine. That's why their market cap's so high. Look at this cash, 20 billion, almost 20 billion, 23 billion, 25 billion, 20 billion, 24.8 billion. Wow. That's good cash flow. And so how does a business become a $350 billion market cap business? Cash. Study the top 10 most valuable stocks on the stock market. Study this line, free cash flow. And it's not necessarily because just invest in those 10. No. Understand the characteristics of that business, and then go find another business like Catalyst that's tiny and they're generating cash, profit, growth. And they're like, all right, cool. I got a small cap that fits that criteria, and it's going up like a rocket ship ride. So I'm trying to see if these guys are discounted now. So free cash flow is at 24,862,000,000. And I'm going to note that. So that's our free cash flow. They're growing at 8%, 7%, 14%. So they're slowing down a little bit. Let's take a look at their balance sheet. Make sure the balance sheet's healthy, less than 3 times EBITDA, right? So they have $34 billion of cash, $81 billion of debt. So they have net $50 billion of debt because you have $34 billion that you can pay off a good portion of that debt. Debt to EBITDA is less than 3. It's at 2.16 because they just generate so much EBITDA. This is a big, big business. So the balance sheet's fine. Analysts are thinking 21 analysts, it's discounted by 56%. Okay. Now, healthcare, remember those stories that are hurting Google? Well, there's stories that are hurting healthcare companies because you have an administration in office and they put somebody who's in charge of the FDA, and maybe I'm labeling the wrong, not the FDA, but the Kennedy guy. He's supposed to go after healthcare companies. So I think people are like, well, we're not quite sure what they're going to do there. So they're a little more apprehensive about investing in healthcare. But for 2025, these guys are going to keep growing. So that looks good. Growth looks really good. Earnings per share are going to expand nicely. Looks real good. Okay. And earnings per share is $29.09. I think cash was, I'm noting a few numbers because we're going to update the valuation on this. One of the members wanted to see United Healthcare, and I wanted to make sure we covered it. And when we look at cash is 34 billion, 290 million. And then we have debt of 81 billion, 270 million dollars. Now let's go take a look at the valuation model. Okay, so last time I updated was in April. So let's start working on some of these numbers. So I'm looking at 2024 numbers, but we now have a trailing 12 months number, which takes the last 12 months, which ended at the end of March. So I'm going to go trailing 12 months times 1.05. I'm being careful not to be too optimistic with this company. And I noted that the trailing 12 months free cash flow was $24,862 million. So that's going to set our forecast. So that in the next 12 months, I think they're going to do $26 billion of free cash. And then next year, which we're talking like at this point in time, 12 months forward, and then the 12 months after that, month 13 through 24, they're going to do 27. And then the year after that, 28, 30, because it's growing at this percentage. And then long-term growth is going to be at 4%. Now, this is a good company, less than 3 times EBITDA on debt. So we're going to use a discount rate of 8. We would use a higher discount rate if they were riskier. Like those smaller caps, I use like a 10 or a 9. International might go 10, 11, 12. So based on that discount rate, all these cash flows are worth $627 billion. I'm going to add cash, and I need to update that number. No, that's correct. Yeah, that's correct too. So the equity value, $580 billion of equity value, which is the value of the cash flows plus cash minus debt. So 580, market cap's 350, 40% discount on United Healthcare. United Healthcare. So I'm going to copy this guy here just from an example perspective. And remember this guy here, right? Where do I put United Healthcare? This is the biggest health insurance payer in the United States. They have the big employers go to United Healthcare. These are employers that have 100,000, 200,000 employees, and they go to United Healthcare. So they have a powerful network of businesses that depend on them. Switching from United Healthcare to another insurance company is really, really, really tough, almost not possible. So they have stickiness, right? Their customers are not going to go anywhere. They have a lot of credibility. They really know their business. They really know their stuff. So they have they're the biggest one because they became the strongest. So I'm going to put them kind of high on this measure, the vertical measure. And I'm not done moving it. So on the vertical measure is the strength of the moat. Their moat is strong. Are they growing? Yes. Are they profitable? Absolutely. Free cash flow? Tons of it. So United Healthcare, I'm going to move this guy just temporarily. I'll just delete it. United Healthcare is up here. It's a good company. 10 years from now, United Healthcare is going to be worth more, a lot more. Is anybody going to compete against United Healthcare? Not really. The closest one is Elevance, and Elevance is like half the size of United Healthcare. United Healthcare is so darn strong. They have credibility at the hospitals, doctors, the people that use United Healthcare. I personally use United Healthcare as a insurance company. My wife is like, she loves the darn insurance. So switching over is going to be kind of impossible for us because she just likes United Healthcare. So this is where I put the desirability of this business. All I need is a rational discount, and I'm a buyer. So going back to the value, 40% is a compelling discount on a really well-known name. So this is a buy. But let's take a look at earnings per share. I depend more on this number, just like Charlie Munger would say, right? He didn't like earnings per share. He thought management had too much freedom to play with that number, and I agree with him. But when I look at earnings per share, it produces a 32% discount. Overall, 37% discount when I blend these two numbers. I take 2/3 of this guy and 1/3 of this guy. So this is a buy on United Healthcare. It's a solid company. I might even buy it because it's just a good business. And not too long ago, the reason I sold United Healthcare is it just became too expensive as a stock. I was looking at it going, guys, the stock got really expensive. You look at the stock, it really rose. And I began to question, it's really expensive. And I was right. Right around here, it started to plateau and I got out, and I think I got out at the right time. Now it's really come down. A lot of bad things have happened. Their CEO got murdered. Just a lot of bad stuff. But this is a very valuable business. So this is a buy. This is a buy for me. And that's my opinion on United Health. We just valued a company. We just evaluated a company. So that's how I go about things there. So Lyft, we're going to take a peek at it. We're not going to do much with it because I got to run. Up 8%. Now, these guys are second place to Uber, and the distance between Uber and these guys is quite dramatic, right? Uber is gigantic. These guys are at 5.9 billion trailing 12 months. And Uber is... These guys used to be closer competitors like 15 years ago. Uber's almost pretty much about 7 times bigger than Lyft. So Uber is much bigger. These guys are growing. That's good growth. And the most recent quarter, that's pretty good growth, 13.5. This is discounted. I could tell you that much. It's discounted. But it's about the market. When's the market going to want to buy into the second place participant and ride sharing? I think the best case scenario for the stock is it gets acquired. Maybe by one of the travel stocks that wants to have Lyft be a service they provide to travelers when they're going on vacation. They could say, hey, part of your package is we give you $200 of Lyft credit, and you can use it any way you want to take Lyft rides or something. So they really have fallen behind Uber. They're discounted. Looks like the stock's really working in after hours. But this stock, I don't know if they've had a sustained rally for a while. See how they rallied in 2024 and really just started cranking, and then boom, they fell back down. So, and they fell back down before the market fell big in February. So that is Lyft. All right. All right, guys. So really good stream. Good to see many names that I hadn't seen in a little while. Thanks for joining. I'm gonna land the plane. And thanks again to Herdo for that super chat. I appreciate it. Goes a long way, man. Appreciate it very much. And as I conclude, love for all of you guys to be members. And to become a member, you just go to the homepage of my channel. You click on this join button. You have three choices. Check them out. Become a member. You'll get access to the tools. You can attend sessions with other members, get on the Discord, all kinds of good stuff. So consider it. Would love to see and love to talk to some of you guys. I mean, I've been seeing your names for over a year and never heard your voice. So that'd be kind of cool. All right, everybody. Enjoy your Thursday night. And let's see what the market does tomorrow. Market's kind of been doing all right for, well over a month. I had a positive month in April. I wouldn't mind it may being positive as well. All right, everybody. Have a good night. Thanks for tuning in.